As you may know, I've made a series of videos on all the technical analysis tools that I use. So I'm going to start with gold, one of my favorite markets, and this is actually a monthly chart for gold. We're going to go through some Fibonacci levels. I'm going to show you how I use them, when they work and when they don't work for low risk trade identification. Quite interesting, actually, just looking at the lower end of this monthly chart from the 1980s through to the 1990s. Markets spend a long time in sideways channels. And as I speak to you in May 2023, there are a lot of sideways markets, and it's really very frustrating because I don't find them easy to trade. But on this monthly chart, isn't it quite interesting? From around the early 80s until the mid 2000s, gold was just trapped in this sideways trend. We bottomed out just after 2001, then started to go up, but we didn't know that this was the beginning of a bull trend for a little while. But on the monthly chart, we did eventually get some really strong buy signals. We broke above the upper trend line of the channel. We had the moving averages crossing over beautifully, indicating that we were finally getting a trend. Now, even if you didn't get in until this sort of sideways consolidation around this flag pattern, you still did extremely well if you bought gold and you hung on to it. Obviously, we rallied from about $650 all the way up to $1,900. Now, I'm not saying you would have run it the whole way, but it just does show how trend lines and moving averages could really get you onto a trend. Now back to the Fibonacci levels, and I do recommend that when you're putting your Fibonacci levels on, you do actually go back to the monthly or the weekly chart, because you do need to know where the longer term levels are. And the point of this chart is to show you exactly what I mean. So if we took the swing low and we projected it up to the all-time high for gold, which is $2,072, on this retracement, if you were looking to buy into gold in the bull trend, this was perfect. 1,642 was the support level, coupled with the 15-month moving average, the black line. What a perfect support level that was. Okay, we overran it slightly. We got down to 1,615. Overrunning the big support level by $25 is nothing on the grand scale of things. And if you did buy into gold here, wow, and held it, you would have been looking at super profits, $300 rally or more as we retest the previous highs. And it is worth noting, look at this potential triple top. This really is a big problem for gold bulls. A triple top is very rare, but if it does hold, that is a very important sell signal. So bulls really do need to see gold break above the 2,100 area for the next leg to start in the longer term bull trend. Now, this is the hourly chart for silver. And as you can see, in the short term, this also works really well. The market was moving down in silver through to the first week of March 2023. And then we embarked on a really nice bull run. So we are now looking at support levels in the bull run to buy into a long position. The market has stabilized here, but the Fibonacci levels are working again, just taking the swing low to the swing high. We've got a really nice support level around $24.62. And of course, that has worked. I've now got a trend line in there as well. So this was the first test of the trend line, coupled with the 23.6% fib and the green 500-hour moving average. This really was a great support level. We've just traded in this sideways, what I believe is a flag pattern. And I do believe silver will eventually break up. Now, if we do break to the downside, break below 24.50, 24.40 would obviously be a short-term sell signal, and it could take us down to the 38.2% fib, which is at 23.72. This is how I would use these fib levels, a decent target for me if I was brave enough to short into a bull trend on a break below the support level. Here's another example. The Aussie dollar has been in a bear trend longer term. And even on the short term, on the hourly chart, you can see how the market was moving down from February 2023 to the beginning of March 2023. You put your fib levels on from the swing high to the swing low. When we did push higher, if you were selling at the 38.2% fib, and we've even got a trend line on there, actually, let me just make that a little bit more accurate. I'm quite particular about my trend lines, just making sure I get the exact peak. There you go. So the trend line coupled with the 38.2% fib has been a great resistance level, especially here when the trend line was tested for the first time. What a great shorting opportunity that was. And we did actually get on that, myself and my subscribers. We did actually get on that trade. It was fairly obvious. I like to have at least two reasons to enter a trade. So if it was the Fibonacci level alone, I wouldn't be that confident. But with the trend line as well, it really did give me the confidence. We're in a bear trend. We're testing the fib level. We're testing a trend line 3 reasons for me to get into a short position at that point. Now we've broken below this lower trend line here. It does look like the Aussie dollar has resumed its longer term bear trend. So these Fibonacci levels really do work very well indeed, very often, not all the time. Sometimes they will fail, but here's another recent example. Cable, pound versus the dollar, had a good run up. We're looking for a support level. Again, 23.6% fib, definitely doing its job at 123.70. For the second test of the fib level, I've now got a trend line giving some extra support to that area. Now the pound versus the dollar has broken above the previous peak. Last example, this is the euro versus the US dollar. So this is how I construct it. I take the swing low, I join it to the swing high. I often get asked, do you join your trend lines and your fib levels to the body of the candle or to the whole thing, including the wick? And I always include the wick. I think you really should encapsulate all the data. If the market has traded up to 110.95, you want your Fibonacci and your trend line to represent that. The other thing I like to do is look for a swing low around the 61.8% fib. And that I can do here, fortunately. Now, when I put this second set of fibs on, this gives me another set of levels. I don't particularly use these levels as entry points, but I certainly would use them as a target if I was in a trade. Now that we have these set of fibs after this peak at 110.95, we have a very strong support level down here with my confluence of fib levels at around 109.60, 109.50, the 500-hour moving average of the green line, and I've now got a trend line from joining these two lows. So there is a huge amount of support down here. And buyers are queuing up to get in around that level. I'm probably not the only analyst who has figured out that that's a strong support level in this euro US dollar bull trend. Maybe we're developing a bull flag pattern here where the market consolidates and pauses after a good run up and then eventually breaks higher. We'll see. Now, just remember, when the market's trending, the Fibonacci levels are very useful indeed, as are the moving averages. But when the market is just trading sideways, these Fibonacci levels are really not very helpful at all. Then you have to rely on your trend lines. So for example, if I was to take this swing low here, project it up to the swing high here, and I was hoping to find trade levels for the Aussie versus the US dollar, it would have been absolutely useless. This is a confusing picture with the market moving up and down violently. So as soon as you think you're in a sideways consolidation, forget about putting Fibonacci levels on your chart. They're just not a reliable enough tool for you to scout with here. Okay, I hope that's helpful. I'm looking forward to getting your questions. Please put them in the comments box below.